Hello and welcome back. This is the third lecture in this risk series. As I've said, there will be 4 lectures. This is a fairly short lecture. I call this risk and uncertainty over time. It's basically taking the 3D charts that we developed in the second lecture and kind of using them to think about what happens to risk and uncertainty as time passes, which is important. All right. As I said, this is the third of 4 lectures. In the first lecture, we really introduced this idea of risk versus uncertainty. And I think it's really, really important, I keep saying this, to separate the idea of risk and uncertainty. It's the uncertainty that creates the unknown. It's the uncertainty that creates the sense of ambiguity or the sense of not knowing. That's the real challenge. And risk is a subset of that uncertainty. So it's important to get, I think, a construct or kind of a way of thinking about uncertainty first and then layer risk on top. We as humans don't really like uncertainty. It's unsettling. If you layer on top of that potential harm, that uncertainty, which is unsettling by itself, and then the potential of harm, you can see why we don't like risk. And in the last lecture, I'm going to talk a little bit about the psychological impact of risk. So I really set that in the first lecture, set up the idea of uncertainty and this idea of sense, a feeling of certainty or a sense of feeling of control. That kind of structure I think is helpful. That was the work that Atwater did, which I think is an important way to think about it. And once you kind of separate those two, then you can go look at risk as a subset of that. The second thing we tried to do in really the first and the second lectures was this notion of investment risk. And investment risk requires 3 elements: uncertainty, which we've been talking about, commitment of capital, and that's key, and then the potential for loss. That's investment risk. And we showed how those two related. We talked about potential return or target return. We talked about margin of safety and things like that related to it. And then we also related it back to the Italian cookie and introduced Montier's structure. He talks about business risk, valuation risk, and then leverage. We'll talk about leverage in the next lecture, not this lecture. But the first two, business risk, really at the end of the day is earnings power value, risk to that earnings power value. And for any company that has excess returns built into its cash flow, then that business risk really is the sustainable competitive advantage, that barriers to entry, threats from competitors. Valuation risk at the end of the day is really related to growth expectations, what I refer to as the market implied value growth. That's your valuation risk. All right, so we set all of that up. Uncertainty, risk, the idea of investment risk, which is the 3 elements, and then the Italian cookie. I'm going to come back to this lecture. This lecture will be fairly short. I think it's only 20 slides or something like that. It's kind of a bridge between where we are and where we're going. And really talk about this idea of risk and uncertainty over time, taking those 3-dimensional charts to the next level. All right. So as we left the lecture 2, it really showed you that uncertainty increases with time. So the range of possible outcomes increase with time. That's really an important notion. We're going to develop that. All right. So I finally figured out how to do 3-dimensional charts, combination of Visio, which is a Microsoft program I've used for 25 years, maybe more, 30 years. I really like it. Some PowerPoint, some Visio, some Excel, the whole thing. And what we're trying to capture is that third dimension. So you want to think about it. These risk charts come out of the page. Hard to show. This does a pretty good job. All right, so our original chart from the very, very, very beginning of value growth lectures, I really talked about this relationship of price and value. Traditional value investing is we're looking for a situation where price is less than value. I can now layer those risk charts right on top of it and show that the potential outcome of value increases over time because uncertainty increases over time, and that's what we really show. So as that uncertainty increases over time, depending on price, risk may also increase over time. Now, interestingly, the way I drew these charts is because price is so much lower than today's value, even with an increase in uncertainty over time, even with a widening range of possible outcomes, there's not a lot of risk in this situation. So if I think about classic value investing paying less than today's value, you can see these tend to be very low risk situations as we draw them, which is sort of interesting. All right, however, point out a couple of things. It is true that the expected return increases as we go forward in time, but the range of possible outcomes becomes wider. That's the key. And the less good outcomes become worse, the left tail extends, and the possibility of loss increases. And I'll show you that in a minute when we're thinking about the growth, when we're adding in growth. All right, so risk increases with the higher level of uncertainty, although the way I've drawn this is there's not a lot of risk. There is risk as you get further out, but not a lot of risk. All right, important. All right, now let's add in growth. Same idea. Growth adds value over time, but the range of uncertainty also increases with that amount of time. So, if you're looking at point estimates related to growth, this is very attractive. That green line is very attractive. But you have to acknowledge that the range of possible outcomes also increases with time. It gets wider. That range gets wider. And so now, as we know, risk is a function of price. In this case, which is interesting, price is lower than today's value. And the way we've drawn this, value is increasing over time because of growth. Even with that wider uncertainty, the growth is offsetting the uncertainty. So in these situations, this is what we all look for. Price is less than today's value. And that value is increased over time because of growth. I'm not paying anything for growth, obviously. And although my uncertainty around what that future value will be will widen as time goes on, because uncertainty increases with time, there's no risk. There's no risk in this investment. Pretty cool, right? However, if we take price up so that price equals today's value, I'm not paying anything for growth, but I still have a widening range of possible outcomes. So now I'm starting to just dip into a tad bit of risk as time goes on. All right, still pretty interesting. So it says if I've got growth, I can pay today's value, and the growth will increase that value, even if the range of possible outcomes is very wide over time. And this was Buffett's investment in Apple in 2014 and 15. He basically was not paying for growth. He got no risk. He was paying for the duration of the business model. That's it. All right. Take price up now. Modern day market price in general, at least for the companies that most people care about, are significantly higher than today's value. And you're effectively forward paying in this model. It's 3 years. 3 years out, you're paying that price today. And so now if we layer in risk, you can see that there's a lot of risk. Certainly a lot more risk. Even if I line the price up today with the value in 3 years, you can see that I'm paying for a lot of risk. Harder to see in these three-dimensional charts, but if you layer on top the charts from before, you can really see that increase. So now I'm hoping there's built some intuition. Number one, even with growth, the uncertainty is going to expand over time. The price you put, risk is a function of the price you pay as it kind of hits that uncertainty. So that interaction between uncertainty, that range of possible outcomes over time, and price determine your risk. So here, if you buy in at price, we've now got committed capital at this price T plus 2. I've got this range of uncertainty, and risk is obviously all of the outcomes that are lower than the price I paid. So we've really, I think, been able to use these tools to capture sort of uncertainty risk over time, which I think is pretty cool. All right, now I can layer on top of that the Italian cookie, all from the market implied value growth work. And you can see in this case, all of the risk is in that market implied value growth, which makes perfect sense. So I'm paying today's value. If I'm comfortable with the sustainability of the company's competitive advantage, blue should hold. You're fine there. But you are paying for a lot of growth in this case, fair amount of growth. And therefore, all your risk is tied to that growth. Well, that intuitively should make sense. So I like these tools. I think they're very visual. I think they really help us capture in our mind where that risk is playing. So if we just think about the Italian cookie, invested capital, you're sort of protected. Present value competitive advantage, you're paying for that today. You're paying for the sustainability of that competitive advantage. There is risk if that gets eroded away, but if you feel comfortable with that, then that's the case, then market implied value growth is where all your risk is. Pretty cool. All right. So with higher growth, good thing, obviously, the same price, if we higher growth, you can see that there's less risk. So growth and risk now become very closely related, as it should be. I mean, that should be intuitive. But we've been able now to really see the idea of the relationship between time, uncertainty, widening uncertainty, price, and then risk. Oh, that's the case. All right. Now, in classic value investing, they always say, I don't care about the future. I think that's a bit of an overstatement. But the implication is you're going to have a fairly stable valuation. So there's your stable valuation. There's your uncertainty rate. And in this case, there's not a lot of risk because price is below even that estimate of value many years out. So in this case, you sort of look at this and say, we're probably okay from a risk perspective. As you widen that uncertainty, even though value is going to hold, but if I have a wider uncertainty, then the price I pay, you could actually see some risk kick in, which is important. All right, this is increasing value with growth. And here, that's a very tight uncertainty range. And because we're paying a low price for this, there's obviously no risk. But even if I paid today's value of today, there's not a lot of risk, as I showed in the earlier chart. So that's the case. However, if you start to think of a wider uncertainty range, now you could see that even though your estimate is that value will increase over time, that uncertainty range is fairly wide, and that uncertainty range is much wider than that uncertainty range, obviously. And so depending on the price you pay will tell you kind of how much risk you're exposed to, which is important. All right, so here is, this is from the very first lecture. In the first case, price is converging to value. That market implied value growth is going away. The second one, price and value hold. And the third one, price to value, the premium expands over time. So now the price, you could see that price in the first one, you're absorbing all of that premium. In the second one, that premium's holding. In the third one, the premium's actually expanding. So in the first case, as you saw to the left, that's essentially shrinking market implied value growth. Over time, either the company's growing into its valuation or investors are over time increasingly concerned that the company's growth rate in the future can't hold. In this case, you have this constant market implied value growth, which is really interesting. That holds. And then in the third case, you have an expanding market implied value growth, which I think is important. All right, so now we get to what is the value of research. The value of research is skew the distribution. And up front, in the second lecture, when I introduced the distribution of possible outcomes, I presented it as a, quote, normal distribution, Gaussian distribution. I was very explicit to say we don't know what the distribution is, but that was a good visual. So here's a case where if you can skew the left side of the distribution, remember, this is the distribution of possible outcomes. If you can skew that to the right, bring in the left side, that market implied risk goes from fairly high to very low. And so that's the value of research. And that's the idea of skewing the distribution in your favor, which is pretty powerful. And here's a perfect example of if I use a market implied value of growth of 6%, that's where we are. My target is growth rate of 7.5%. But I've been able to really do a ton of research and figure out that the low growth rate, the industry's growing at 6% or something like that. Not that it's guaranteed, but there's a high degree of likelihood that the company will be able to do 6%. Now all of a sudden there's not a lot of risk in this name, which is kind of interesting, right? You don't see a lot of risk because you've skewed it to the point where you think, under almost all circumstances, the company will be able to grow 6%. Your target's 7.5%. You're only paying for 6% growth, so you're getting that extra growth for free. But you've skewed the distribution. So whether you skew the distribution from a target price perspective or you skew it from a growth rate perspective, that research can skew the distribution. That's very powerful. And then if we layer on top of that the Italian cookie, you can see here, even though you're paying for market implied value growth, you're paying for it. It's actually a very low risk situation because the 6% is not a gimme, but you got an industry growing at 6%. the company should be able to just hold share and grow in line with the industry. So now you can see that there is not a lot of risk from a perspective. Even though you're paying for growth, you're not overpaying for growth. All right, I want to end the lecture there. We're going to go to the fourth lecture next. That's where we're going to kind of try to bring this all together, talk a bit about volatility, talk a little bit about risk management. All right, thanks.